Welcome, everybody. Thank you for your patience. It took me 1 minute over, but we are here, and I'm very excited to be joined by CapChase, to be joined again by Maria Beretta from CapChase again. She's the Director of Partnerships, and we are going to talk all about not fundraising or a different kind of fundraising. We're in the Grow curriculum for our GUST programming, which is all about kind of the post-launch, situation of a company where everything is about establishing and building traction. And you've seen a ton of our programming. If you've been into other parts of this series, we've talked about, various kinds of fundraising, various kinds of like insurance protections, product launches, ways to grow things. And GUST itself connects tons of founders to accelerators and investor groups, which predominantly do equity-based fundraising or convertible-based fundraising, some kinds of fundraising that we're familiar with in the space, selling stock and somewhat. However, that's not the only option. And considering your growth trajectory for your company is very specific to your company. I would never advise anybody to just go VC or bust or only go after angels or only do this. It really depends on the nature of your business. And one of the things that you can actually use to fuel growth in your company has nothing to do with selling a part of it. It's actually investing, basically borrowing from your own future. And CapChase is one of the innovators in this solution, which they call revenue-based financing. And we have Maria here to basically tell us all about it, a deep dive into revenue-based financing. So one, you can see, is this a growth potential for my company? Is it at the right state? If it is, how does it work? How do I get involved? What to expect? And probably everything in between. So without further ado, the normal stuff. Yes, we're recording this. We will upload it and put reach out shortly after it wraps. Give me a couple days. Please use the Q&A in the chat. Feel free to throw your startup names and where you're coming from in the chat. And the Q&A, if you definitely have a question, we will get to it. I'll surface some up during the presentation if they're really relevant, and we'll save some for at the end too if they're specific or just more broad. And without further ado, Maria, take it away.
So first of all, thank you to the entire GUST team and everybody for joining to learn about this type of financing. Revenue-based financing is a type of funding that has become a lot more popular over the past few years, but still a lot of founders don't know how it works. Is it good for me? How I can utilize it? And especially this last question is very important because it's not, it's not about just accessing it, but using it in a very efficient and capital effective way. So we're going to address all those topics today. So I have this brief presentation here that we're going to go through to walk through these topics. And as Ryan was saying, if you have any questions throughout the webinar, feel free to drop them and we can answer them throughout. This is meant to be extremely casual and informative. So feel free to jump in and address the questions that you want to learn more from. So without further ado, as Ryan was saying, I am a Director of Partnerships at CapChase. For those of you that don't know CapChase, and even before I jump into CapChase, I actually started my career in venture capital. And one of the things that was very clear to me is that fundraising was something that most founders really despise. There's only a very small portion of founders that lift the rock and there's like a $10 million round at with pre-revenue and all of that. But for the vast majority of founders, it's something that is time consuming. It's a lot of no's before you get a yes. And when the CapChase concept came by me, it was really early and it was about providing more financing sources without dilution in a very fast and effective way. So founders can really focus on growing and building their businesses. And I thought that's definitely something that it has to do well. It's very different. It's very innovative. And if anything, just founders need more options. So that's how I found myself to CapChase. And at this point, we've made available close to $2 billion in capital to thousands of businesses. So it's been really great to see this concept take off, but there's still a lot of understanding to do in terms of how founders can really make the best use case of it. So why don't we jump right in? So before we even talk about what revenue financing is, why is it particularly relevant at this point? And what's really interesting here is that this is research done by Allied Market Research, and they're looking at the size of the market from 2019, which was at 900 million, to 2022, which grew significantly, but the growth that we expect from now to 2027 is astronomical. So this is something that clearly the expectation is that more founders will be more comfortable using it and utilizing it and not only relying on the traditional just venture capital. And something really to talk about the times that we're in and why revenue-based financing is relevant is that the time, between rounds has really gone into new highs. So in this graph, you can see, the average days between price rounds from seeds to Series A, from A to B, and from B to C. And you see those basically hitting total highs since 2018, and it's no surprise that last year it just became harder to raise, especially since May of 2022, and we can see that in this graph. And as a result of that, right, the total cash raise has fallen over 50% from 2021 to 2022. VCs are being a lot more risk averse. They want to sit this out because they don't know where the economy is going to be. So it's not as easy as, the good days in 2020 and 2021 where raising capital just became really easy. That was quickly retracted in last year.
And we don't have the full stats yet, but I'm pretty sure from what I've seen from quarterly reports, 2023 also doesn't seem like it's a rampant tick back up.
Exactly. And at the end of the day, in venture capital, it's a little bit of like a demand and supply game. And if there's less supply of capital and more demand for that capital, as you guys see here, deal terms will become a lot more investor friendly. Valuations are going to drop, and a lot of founders are faced of like, okay, am I going to raise at a lower valuation, dilute my investors, myself, and my employees, or what do I do to extend runway, right? And so all in all, it's just been a much challenging fundraising environment, which has left a lot of founders thinking, okay, what options do I have? Because this is not my 3-year plan that I had set, right, in 2020 or 2021. And as you're saying, Ryan, right, this year, there's definitely been a fair amount of challenges. I think a lot of people were thinking, 2023 is it just has to get better. And definitely we all are probably familiar here of what happened with SVB and FRB and Signature Bank, which some investors are definitely wanting to pull back and just continue to watch the environment and being a lot more selective and taking longer to perform due diligence before they go ahead and pull the trigger and invest in your company. Now, it's not all dark and gray because now there's definitely more options, and revenue-based financing is, thankfully an additional tool that a lot of founders can leverage. It's not here to replace venture capital by any means. They have different use cases and purposes, and we're going to go through that. Talking about where we come from and what are the historical options for startups to raise capital. Probably a lot of you are very familiar with this, so no need to go into the details of this, but you start with an idea, you get angel investors and accelerators, grants. Once you get closer to product market fit, VCs are going to come in, institutional investors to invest in exchange of an equity portion of your business. After you're in Series B and you're backed by a certain number of institutional investors, banks can come in with venture debt. And, crowdfunding definitely has taken off over the past few years as well, and it's become a popular way of fundraising across all the different stages. Now, interestingly, revenue-based financing just came, and became really popular. I would say in the past 3 to 4 years, it has existed before that, but it really took off 3-4 years ago when more SaaS businesses started utilizing it, and you had, companies like CapChase or Pipe, open up and really become, there was more awareness in the market of these different financing options. And revenue-based financing, as the name says, it's based on your revenue. So you can definitely access it earlier in your business, but the most important thing is that your business is generating revenue and retaining it for you to be able to access it.
I really like that chart too, because it mirrors perfectly the chart we use for the fundraising workshop we did as part of our last series. I think David even did it. I don't think we actually had revenue-based fundraising in it, but it's the same stacking and the curve and whatnot. And it's nice to see that pop up. Very cool.
Absolutely. And there's obviously smaller or alternative financing options that you can leverage. I would just say that revenue-based financing, and obviously for the purpose of this workshop, it's really become a category in itself. And we have clients that have used, all these different funding sources, all at once, right? And those are the most sophisticated founders that can really combine these different sources. So yeah, I mean, hopefully revenue-based financing becomes like a bar in like almost every chart that gets used. And the reason why revenue-based financing exists on the first place is because the greatest strength of a recurring revenue business is their future revenue, right? So they sell in contracts, they have longer term commitments. And even though these businesses early stage have a good amount of risk, because at the end of the day, every startup has a high level of risk, there's something really, really valuable about these SaaS and recurring revenue businesses is that they're a lot more predictable. They're a lot more stable. They're more resilient to shocks in the economy because a lot of these contracts are definitely tied to their customers versus something more that's like discretionary spending or D2C that can just more easily be cut. B2B SaaS and recurring revenue businesses are just a lot more attractive to any capital provider because of that recurring nature, more predictability, higher retention. So as a result of that more valuable business model, historically, it's just why didn't these businesses already have more access to financing, and why was it so hard to access, debt or non-dilutive financing from banks for these like really early stage businesses? And that's the whole purpose of why revenue-based financing like really took off. And to describe what revenue-based financing is essentially taking advantage of your future expected revenue and raise financing on the back of that. So in this graph that you have here, right, you have, expected contracted revenue that you expect to receive in January, in February, in March, and in April. And revenue-based financing is telling you you can access 20 to 60% of that annual recurring revenue in the form of financing that acts like a line of credit. And obviously, dollars today is more valuable than dollars tomorrow, because those dollars today allows you to reinvest it in your business to accelerate your growth to then have more revenue down the road. So in summary, is basically taking advantage of that highly predictable recurring future expected revenue that you have to access financing today. Any questions on this concept that's coming in the chat before we dive into the details?
No, I think you're doing good.
Excellent. So who, what type of companies tend to access revenue-based financing? So it's those companies that want to fund their growth without additional dilution. So they're, whether you're VC backed or bootstrap, you can leverage revenue-based financing. You don't need to be VC backed to access this. What revenue-based financing is looking at, and we're going to go into detail in a little bit, is how much revenue are you generating? Are you retaining that? Are you growing in an efficient way? And for that, you don't really need to have a cap table of investors, which is very common for venture debt. Is essentially, you have your revenue and it's stable, and you want to continue to fund your growth without having to just always have to go to your cap table or your investors to raise that capital. You also want to access capital faster. So my point earlier of how historically founders just spend months to over a year trying to raise a Series A or a Series B. Here is a form of accessing capital a lot faster, so you can really focus on growing and building your business. Time is money at the end of the day, so it's for those founders that can really want to accelerate that path, and you want more flexibility. So you want flexibility of terms, you want flexibility of pricing, and flexibility of how much capital you really want to access. So those three things really determine whether this can be something like highly valuable to you. Talking about how it actually works. So as I was saying earlier, it's the revenue-based financing is usually as a percentage of your ARR. So let's say that you are 1 million in ARR, you're gonna get financing that will range between 200,000 and 600,000. And that really will depend on the stage of your business, on how fast you're growing, on how healthy your retention is. That will determine whether you're more on the 20% or on the 60%. Once you're approved for that, and here's where the flexibility comes, is that you can use it as like a line of credit. And usually SaaS businesses, like some of them are cyclical. You know, if I get $600,000 in financing, I probably don't need $600,000 on day one. So revenue-based financing, for the most part, allows you to essentially only draw funding based on what you need on that particular month and only pay for what you use. So here in this graph, we can see like, okay, in January, the needs were 250,000, February came down, March were higher. And why is this relevant? Is because you don't want to pay for financing that just basically is going to sit on your bank and you're not going to use all of it, which is common for venture debt. Like if, once you essentially draw 100% of your, once you draw from your venture debt line, like you need to, it acts like a term loan. So you need to draw the full amount and start paying for it. So with revenue-based financing, you basically only pay for what you draw.
We got a couple questions on ARR in the chat. For the purposes of, Seth asked, for the purpose of revenue-based financing and that 20 to 60%, which definition of ARR are you using? Is it MRR 12x? Is it trailing 12 months? Something in between? Maybe actually give a bit of an overview of ARR first, just in case people don't clearly have that in their heads in the various ways to calculate it.
Fantastic question. And there's definitely the rule that, we follow at CapChase, but each revenue-based financing player will have, in a way, their own formula for ARR. And sometimes it happens where like a company comes and it's like, oh, my ARR is, 10 million. And then when we go and calculate it, like we have a different figure. And the reason being is because different revenue-based financing providers have different ways of calculating, but for the most part, it's basically taking the most recent MRR and annualizing it. That's the simplest calculation, unless we see some really big seasonality in your MRR. For the most part, it's essentially taking your MRR, your most recent MRR, and analyzing it to come into an ARR figure.
Excellent. And we do have a question on government contracts and grants. So that was actually in your chart before, bridging the gap from honestly ideation all the way into revenue. How does that interplay with this type of financing?
Yes, good question. So it needs to be revenue. I mean, if it's a government contract, the government is your client and it's contracted revenue, that would be part of your ARR base. A grant, more like a financing grant, that like we don't really consider that. There's some times where there's like a little bit of like a blurred line between a government contract and a grant. But if it's a grant, usually that's not considered into the ARR. But if it's a government contract or a government pilot, that would be part of your ARR.
Excellent. Great questions too. Thank you.
Of course.
And I guess Sanjeev actually asked one that is very relevant, and I was going to make up at some point anyway. But what if you're a bit of a mixed business model? So you have a subscription revenue, but then you also sell transactional services or something like that. Does that factor into the ARR calculation for you guys?
Business model, which is very common. In this case, you're describing a hybrid business model between contracted revenue and transactional. A revenue-based financing player will, for the most part, underwrite your contracted recurring revenue. So the ARR would basically be based on that contracted recurring revenue piece, and the transactional piece won't be underwritten per se. Other hybrid models could be a hardware and a software model, which in that case, we will definitely underwrite like the revenue that you make from the software piece.
And what if I have like 7 years of transactional revenue that's like ultra stable on top of my subscription? Does that factor in at all? Is it binary? So we're putting the screws to it.
It's a fantastic question. And my underwriting team has a lot of fun all the time with these very creative business models. And there's this whole concept of reoccurring these business models that they're not necessarily like contracted on paper, but there's such long-term historical data that you can see that there is recurrence in the transactions that are coming back. I would say that that's on a case-by-case basis. In this environment, however, it's become harder to justify that these transactional business models are true, like let's say just contracted recurring B2B SaaS. The reason being, and obviously my risk team, what they will argue is like they're just more susceptible to shocks in the economy versus if that revenue was contracted and the client was essentially forced to pay you no matter what.
Awesome. And thank you for all your questions in chat, everybody. I think we're good. Let's keep going.
Excellent. In terms of the pricing, this is a very, very popular question. You're like, okay, this sounds great. Percentage of your revenue, you can use it in a very flexible way. How is actually the cost of financing? So the cost of financing also will be dependent on the revenue-based financing player. For the most part, that will range for a 12-month term between 8%, and it can be as high. I mean, with interest rates rising, like some revenue-based financing buyers can be as high as like 14%. But for the most part, I will say is that they're between 8 to 12. And that's a discount rate, which is an important definition to give. So in this case, it's always easy to explain it with a live example. As I was saying, it works like a line of credit. So this company has an available credit of 3.4 million, which we see here. Their rate is 8% and their term is 12 months, which is important to note that this term is 12 months on a per draw basis. So every time that you draw, you're going to repay that in 12 equal monthly installments. So the whole goal of revenue-based financing is being extremely simple in how it's charged. So there's no warrants, covenants, security interest, personal guarantees, prepayment penalties, legal fees, like all that jargon, and especially it's very common for some of these bank lending products. For revenue-based financing, for the most part, it's a one-time rate that gets charged every time that you draw. So for this company that has 3.4 million available credit, they just need $1 million on day one. So they draw $1 million. And here you can see that they essentially pay 8% on that. So they're going to repay the revenue-based financing provider $1,086,000, the cost of financing being $86,000. So in simple math, you draw $1 million on day one and you repay $1,086,000 in 12 equal monthly installments of $90,000 and change every month. And that's really it. That's the only cost of financing that gets charged. We get a lot of questions whether this rate fluctuates. Again, some revenue-based financing providers they'll have different policies. For the most part, it should be, you can never guarantee that it's going to be fixed with a changing rate environment. So our rates, they used to be between 6 and 9%, and they're now between 8 to 12% because obviously our cost of financing has increased and we need to pass along some of that. But for the most part, once you start at a specific rate, unless we see massive changes to the Fed's rates, it should stay fairly stable. And on the draw, once you draw, like the financing cost of that draw won't change. What could change if the Fed, hikes rates again, it's on future subsequent draws. But we don't expect the Fed to raise like in the short term anymore. So we don't see rates like having to change significantly. Okay, and then something that is quite attractive for revenue-based financing is that, and for the most part, a lot of providers have built a good amount of technology to collect this information in a seamless way and be able to scale with you. So as it's ARR based, we were saying 20 to 60% of your ARR. As your ARR grows, if your revenue health doesn't decrease, you will see that access to financing grow hand in hand, which is really nice because that way you don't need to go to a different bank or go to a massive re-underwriting process to access for additional funds. It's like, okay, this is a financing product that will scale with me, and as my needs grow, so does my access to capital. So that's a nice little feature for revenue-based financing. And comparing to kind of how revenue-based financing stacks with all other different types of products. And again, I'm never a person to say one is better than the other. They have different purposes and they also have different profiles. And based on what you need as a business and what's important to you, you should tap into one or several use of financing. But this is a nice, easy chart to see how it compares. So revenue-based financing is fully non-dilutive. You can access to capital fairly fast compared to the alternatives. As we were just talking about, the fees are fairly simple and it doesn't have covenants, which for those of you that are not familiar with what a covenant is a certain requirements in terms of your business and your traction that you need to have to be able to maintain access to that financing. And it's very common for venture debt and banks to say your performance needs to look like X for you to continue having access to these financing. And if it goes below that, they can essentially pull the financing from you. So this was common. Last year, we would get a lot of founders that were saying, oh, we're super close to hitting our covenants. And if so, and the covenant could be pretty punitive, where it's like, if my runway falls below a specific threshold or my cash balance, they can essentially pull the trigger, and that can be like very detrimental to your cash flow and your business. So that's something to be very, very careful with what covenants you're putting yourself under. If there's a changing in the environment, you don't want to put yourself in a pickle, let's say. And revenue-based financing, as I was saying, it doesn't have any warrants. Warrants, for those of you that don't know what that is essentially the ability to purchase equity in your business down the road. So in a way, while it's not dilutive on day one, it's essentially a promise to be dilutive down the road. So if a specific financing product has warrant, you can consider that to be slightly dilutive in your business.
We got a good, so good. Sorry.
Oh, go ahead.
I was going to go with the question, but if you want to finish that thought, I will wait.
Go ahead, because I was going to jump straight into VC.
Okay. So Fabian, who's been the source of great questions, asks, in this case, is revenue-based financing similar to factoring or receivables financing?
Fantastic question, and something that we get a lot. So in factoring, the difference between revenue-based financing and factoring is that in factoring, essentially you're underwriting a specific contract and you have that relationship with the underlying kind of business, instead of like the actual client that you're financing is more like the underlying client of that business. Where revenue-based financing, the relationship is directly with the specific party that's getting financed. So for our customers, so to give you an example, we are financing company X, which is a B2B SaaS company, and B2B SaaS company is offering their software to Coca-Cola. Factoring will basically like intervene in that relationship and collect from Coca-Cola for basically the payments of those contracts. Revenue-based financing is just basically saying, you company, B2B SaaS company, I see all your contracts, I see all the clients that you work with, your retention, and I am fairly confident that you're going to be able to repay me this amount of financing if I extend it to you. So our relationship is directly with the B2B SaaS company. So that's the difference between factoring and revenue-based financing. But the premise of revenue-based financing is we are assessing your revenue growth and how likely are your customers essentially, willing to stay with you.
Excellent. And a follow-up from Fabian is just, does it require similar personal guarantees from the founders or the owners of the company?
Yeah, so it doesn't. There's, who knows if there's like a small revenue-based financing provider out there that does. For the most part, revenue-based financing does not have any personal guarantees. It's unsecured financing. And in that way, very flexible that there's no personal guarantees.
All right, we have a couple more specific questions, but I'm going to save them to the end in case you nab them in the rest of the presentation. But don't worry, Calvin, Bobby, Robbie, we will get to you.
Just comparing very quickly revenue-based financing to other common financing products from B2B SaaS for B2B SaaS companies. So the difference between revenue-based financing and VC. So VC obviously will be dilutive. It takes longer to finance. Fees are, the cost of financing is usually not simple, I'm sure you've seen term sheets from VCs. They could be very complicated and you're signing up for things that later on you don't understand, that you're like, I wish I did back then. So it's definitely that probably requires its own masterclass to just dive into term sheets and terms.
Or several, if you can even get to a term sheet.
Exactly. So it's beware of definitely what you sign with your investors. At the end of the day, they're usually the ones that are taking the most risk, and this is a form for them to protect themselves as a prior VC. It was kind of that perspective, but there's a lot of VCs that are very predatory, and a lot of founders should not be agreeing to a lot of those things.
And even just the expectations of the business, like VCs, well, depending on the stage, but most investors are looking for outsized returns. The X's, double-digit X's, 10x, 30x, whatever. The world gets really weird when we talk about like SoftBank era VC. But if we're talking earlier, like Series A and Series B, they're not only going to be looking at your actuals, which your actuals could be very healthy. You could have a growing revenue model that is getting, growing and maintaining your churn is good. But they're all stuck in the conjecture of like, oh, is this going to fit in with the portfolio play? Is this going to be, in every house in America? Is this going to 100x our return on investment, et cetera? Is this marketplace capturable? All those factors will enter into the investment. So even if you're showing them lovely actuals and projections, it might not fit in with the hockey stick growth that they're looking for. But if really you just want to hire a small team to pursue an initiative rather than one person at a time over the course of 12 months based on your slow revenue growth, you can really change the game and even make it complementary. Like, even if you are still VC bound, why not get there in a shorter period of time? So I feel like there's more of a purity in the mathematical approach of revenue-based financing than the like somewhat mathematical approach, narrative approach, and portfolio approach that is necessary to fundraise for equity.
You hit that's exactly right. And we're going to talk a little bit about how to combine those two. If you are VC backed, how you can combine them to be extremely capital efficient. But to talk about, what these two players care about, that's different. A VC, as you say, will be a lot more forward looking, and will, in their due diligence, they're going to be basically assessing like, is this going to be 100x and this is going to be hockey stick? So they're not going to care so much about like, historical performance, depending on the stage, but this is particularly early stage, where the due diligence of revenue-based financing is, we're looking at your historical data, and we're looking at your like historical contracts that you've signed and how they've retained. So the due diligence of revenue-based financing is more looking at the past, where due diligence of venture capital is more looking at the future and how likely is this to 100x. Venture debt, it usually comes after the Series A or Series B, so different non-dilutive or slightly dilutive, really, financing model that their due diligence is more focused on your cap table and what is the likeliness that your investors in the cap table are you going to follow on in future rounds. So venture debt shops will have like tons of relationship with VCs, and that's how they kind of make decisions whether to fund you or not. They can fund you even before you have revenue, but if you're backed by Sequoia or Axel, they're willing to give you a venture debt term sheet. So very, very different due diligence model. It is dilutive because it has warrants. So venture debt, beware sometimes, and venture debt is really good for specific use cases. The cost of financing from a rate perspective might come in lower, and you might think, oh, like this is cheaper in a way that revenue-based financing. The difference is that if you calculate what the cost of the warrants are once you scale and grow the business, they're definitely more, venture debt can be a lot more expensive than what you think. So something to be mindful of those warrants. And then banks in general, more like term loans from banks or revolvers, lines of credits from banks, can be dilutive, can have warrants. Usually the fees of those banks are not the most straightforward always. Banks, and you probably also know that banks are slow and clunky, and the way they collect their financial information might drive you crazy. But hopefully with the evolution of technology and solutions out there to automate the due diligence process, like banks will get a little bit better.
I think it's going to be a long time before banks are actively investing in new and innovative business models. Maybe the business model isn't innovative, but startups are high risk, high uncertainty, and it just doesn't meet the needs of the banker's spreadsheet. And I think it will almost always be that case. We might see business models emerge that create startup like, in 20 years, will a bank look at a B2B SaaS company in a known market with a known strategy the way they would look at a restaurant and be like, hey, these business models make sense. So like we do some financing on that kind of thing. Maybe, but usually the nature of startups is like that business model is 2 decades old. It won't work. So banks are tough. Usually it's a waste of time for a startup. Although our audience is predominantly startups, but is CapChase only for startups, or are there businesses that might not aspire to go on to VC or need angel funding or, top off? Are they still possible clients for CapChase?
So if you're B2B tech, B2B SaaS, CapChase can work with you. So you don't have to be VC backed. So we have a lot of bootstrap businesses. We have some clients that are, large B2B tech companies that just never raised $1 of VC. But it's very important for us, at least, to have that software component, whether you consider yourself a startup or not. But I would say a big percentage of our customers would categorize themselves as startups.
Great, thank you.
Of course. And then talking about how you can actually utilize revenue-based financing and what it's best utilized for. And here's where we're going to dive a little bit deeper on how you can combine it with other funding sources and what you should use revenue-based financing for and what you should not. Because there's definitely a long category of things that we don't recommend you use it. The best use case, given that the term of financing is 12 months, which you can consider that short term, is better for shorter term predictable investments, right? So this is not equity, this is debt, so you need to repay it. So you should put that money into use cases that you have a high percentage of confidence that you're going to be able to repay that. So what's a good example of that is growth, right? So you have a growth engine, you know what your customer acquisition cost is, and you're fairly confident about what your payback period is. You should not be spending your expensive equity dollars for customer acquisition, because that's a very predictable GTM model, especially once you really understand what your CAC is and payback period. So most of our customers really use revenue-based financing for this use case. So I know that I need to spend, let's say, $10,000 to acquire, that's my customer acquisition cost, $10,000, and I repay that. Usually my break-even point is going to be in 6 months. That's perfect, because you draw from CapChase 10,000, you reinvest it to acquire that customer, and in 6 months, boom, there you have a customer break-even point, and you didn't have to spend $1 of your equity capital or any cash that you had on the bank. So growth is what most of our customers use us at, because it's a shorter term predictable investment. The second one is hiring. This is particularly the case for sales and marketing hires. Very predictable investment. So if you have an AE, a BDR, marketing executive, for the most part, your finance team will have a fair amount of confidence in terms of when this specific hire kind of pays off, based on the ramp up period and when this person is going to essentially start bringing business in. Hiring, sales, and marketing is a very, very common use case of revenue-based financing. Large expenses, this can be things like, and we had several clients that use this, like SOC 2 certification is a chunky, expensive cost for a lot of businesses. You sometimes need to hire engineers to become SOC 2 certified specifically for that, and that can be expensive. But if you have SOC 2 certification, you can unlock several clients in your pipeline that are not moving because you don't have that certification. So drawing funding from revenue-based financing for a large chunky expense like that is a common use case. And then the fourth one here is filling cash flow gaps. That's a common one, working capital, filling cash flow gaps that based on when you need to serve your customers and when you get paid. Do not use your expensive equity capital to fill those cash flow gaps. You can use products like revenue-based financing. And I would say something that's not here that has become really popular since last year, and this happened a lot, is companies were planning to raise last summer, and they had made all their forecast and their cash flow projections to essentially plan for receiving a cash inflow from an equity round in summer. And obviously valuations dropped. It became a lot harder to raise capital, but the business was still doing fairly good. Maybe growth slowed down a little bit, but they couldn't raise capital. So using revenue-based financing can be a form of bridge financing that allows you to raise capital in between funding rounds to improve your metrics, right? Because you're going to inject that into growth and customer acquisition and have your numbers look a lot better, so you can increase the probability of raising an equity round and raising an equity round at a higher valuation. So a fifth bullet point here would be bridging yourself to the next equity round without necessarily having to do an internal round and diluting, your existing cap table. Moving on into what metrics need to look like for you to access these type of financing. What most revenue-based financing players will pay attention to are these four. Are you growing your revenue? And is it growing positively? It doesn't need like massive, revenue growth expectations like it's the case with venture capital. It's more about like, are you growing in a sustainable manner? Gross margin is important, especially, with B2B SaaS. Ideally, best case is above 80%, above 50% gross margin. You should still be able to access, revenue-based financing. Retention is a very important, because at the end of the day, you're leveraging future expected revenues to access financing today. If you lose that revenue in month 2 or 3, that's something that revenue-based financing players don't love. So retention year over year is highly important. And the fourth one here is growth health. So what are your unit economics? Are you growing in like a positive unit economic way? And are you growing in an efficient way? So I don't know if everybody here is familiar with R40, but R40 is a metric that helps you measure your growth efficiency and how, in a way, profitable you're growing. And this is something that now VCs are paying a lot more attention to. R40, in fact, is becoming also for publicly traded SaaS companies, the North Star metric as a multiple to valuation. So valuations are now being really determined by that capital efficiency, which is measured by R40. And so combining it, right? And you were hinting at this, Ryan, a little bit earlier about how you can combine some of these capital sources. Again, venture capital has a very important use case, especially, again, if you're a tech startup, B2B SaaS company. They provide a lot of strategic advice, and it's not only about the value that they bring in terms of the money that they put in your business. So what we tell our customers is venture capital is really great for longer term, unpredictable investments. So that can be building a new product, growing a product and engineering team, launching a new market, all the moonshots that you basically are super important to take your business to the next level, but you don't know if it's going to take you a year, 2, 3, or 5. VC, because you don't need to pay it back, it's very, very good for that. And revenue-based financing is good for that shorter term predictable investments that we were just talking about: growth, customer acquisition, working capital, hiring sales and marketing folks. And using these two can really, and this is something that everybody's talking about since last summer, is capital efficiency. Capital efficiency. So combining these two can really allow you to preserve your equity capital for those like really moonshot bets, and you don't even know for how much longer you're going to need runway for, and really draw from revenue-based financing for anything that's a lot more predictable. And in using both can really help you make the best use case of all the capital that you have. What's also interesting to mention here is that it's not only, as I was saying earlier, for VC-backed companies. Like, it's been very common for CapChase to work with bootstrapped businesses, repeat founders. They put the first seed capital. They didn't take any outside money. They were extremely, capital efficient at first, and then they skipped through the pre-seed and the seed, and they leverage revenue-based financing in the meantime to not dilute themselves because they didn't feel like they needed to. And then they just jump straight into the Series A. So we've seen several of those cases, which is definitely, the most dilution comes in those earlier phases. So it's definitely a lot that you can save.
Yeah, we always say if you can skip around, you have given yourself like a major level up. And especially if you're bootstrapping and you're not, hinged on that first seed or pre-seed round to really just get to market or get to traction. I'm sorry, it's not get to market or get to traction. That is true also, but once you even get small amounts of revenue, or if your business model is small amounts of revenue to build into something bigger, it can be massive.
100%, 100%. So a little bit of a summary on us, just to kind of like bring this all together and how we made it all the way to here. I mean, our whole mission is to really give more financing options to founders so they can really make the best decisions for their business and really not have to drag themselves to like, how do I access the capital that I need to really achieve the vision that I have. So that's our whole mission, to really put the capital in front of the founders in the right way. For a lot, get a lot of questions. Okay, how does it actually work to, access financing? This specifically is how it works for us. Although for other revenue-based financing players is similar. Some will be faster, friendlier, and so on. But for the most part, and here's the process that CapChase follows. Despite a lot of technology having been built, it's super important, at least for us, to be very relationship driven. So first, understanding what are your needs, what do you need funds for. We've had cases of founders that come and they're like, I need a corporate jet, and we're like, you know what, that's a really compelling use case and need for financing, but not revenue-based financing is not the right use case for that. So that first call really allows us to understand whether this is a fit. Once that's assessed, you come into the platform, you connect your banking data, accounting data, and billing data, mostly through integration. So that process only takes a couple of minutes. Because of this technology being built and the fact that we don't need to be sharing PDFs and spreadsheets for weeks and weeks, we can get back within 48 hours with at least an initial set of questions or preliminary offer. Once it's approved, companies can go into the platform and say, okay, from that 3.4 million that has been made available to me, I only need 150,000 today. You can basically draw your capital immediately, and essentially you can rinse and repeat. And every time that you need more funding draws, you can come into the platform and repeat the process. In terms of requirements to be eligible for, this is specifically for CapChase financing. For most revenue-based financing players, you will see this available on their website. This is information that's pretty public for most, but it doesn't range a lot in terms of like eligibility requirements. Definitely, the most important eligibility requirement is that you have that contracted recurring revenue business model. That will be the first filter in that sense. From there, the minimum ARR requirement for us is 150,000 in ARR, and from then on, we've worked with companies that are over 100 million, so the range is pretty wide. Runway is important. Sometimes what happens is founders come like last minute, like, oh my God, I couldn't raise my equity round, and now I have 3 weeks of runway. It's like, wish you came to us, beforehand when you were still raising. And it's important to access these types of financing. And as you know, everybody says it's better to raise when you don't need it. So the more runway that you have, the better terms that you will see. Positive revenue growth year over year is very important. And here you can see some of the countries that we operate in, US, Canada, UK, and in several European countries. And then
does that include, for the US, is that any state incorporated? Are you Delaware only, or you don't care?
US.
That's for you, Bobby.
Yes.
So we have a question on what runway is.
Yes.
You know it, I know it. I'll let you have it.
Yes. So runway is essentially how many months of essentially cash you have in the bank to fund the operations of your business. So if you're a bootstrap company or profitable, you don't need to worry about this. But if you are cash flow negative or unprofitable, runway is an important metric for all these players to assess, okay, do you have at least 5 months of cash in the bank to fund the operations of your business? Once it falls below that, it gets a little tricky.
Yeah, you're kind of in a death spiral. But the raw math is like, if you raised $1 million to run your company and it costs you $100,000 a month to stay in business through salaries and servers or cost of goods sold and everything, you've got 10 months of runway. If you are profitable, you technically have infinite runway. That does not mean your business is done and you'll never go out of business, because that can go down. But basically runway if you can pay for your expenses every month with your revenues, you are effectively evergreen for now.
And of course, we wanted to be appreciative of everybody that came to the webinar. And if we have any of you guys that are looking for additional funds, raising capital without dilution or being more capital efficient, or you're just curious and you're like, you know what, I just want to see if I have any access to financing, because, you know, we love our partners at Gust. We wanted to give you guys a discount for your financing rate if you access financing through CapChase, which you can access in the website here, capchase.com/partners/Gust. You can go through that, or if you just want to email me and have a separate side conversation, my email is maria@capchase.com. So that's an easy one. Always happy to chat if you guys want to dive deeper into any specific topics that we just touched on.
And I can attest, because we try to do this with all our partners, well, our closest partners, is we've actually went through the process ourselves just to see what it was like, because it almost sounds too easy, like a handful of days and a little bit of, API or integration, and you can get a quote. Well, it takes 6 months to convince a bunch of stuffy rich people to actually write you a small check. And it's a very nice service. I'd recommend anybody, if you have the revenues and you want to explore it, you don't have to do anything, but you can have the conversation. You can, get to learn what your options are. And it's not like they're, putting you on the hook to be like, and now you must take our money. It's just a really good way to get some insight. And what are your options for your business? Because maybe you don't know what you would spend it on right now, but knowing a rough level of credit that you could get when that, partnership, that project puts up, that opportunity, you run a new website ad campaign, and the CAC is so much better. Like, you can raise money to plumb it in. A lot of times, I was talking in the chat with some people about CAC to LTV ratios. If you can put $1 into a channel and take out 3 within a handful of months, sometimes it's like, how many dollars do we have lying around that we can put into that channel? And if it's not, tons, maybe we could get it from somewhere. It could be a really cool opportunity. Awesome. We have a ton of great questions. Are you ready for them, Maria?
Yes, let's go for them.
Okay, we have way back Calvin Holt. Thank you for being patient. So he's negotiating with a client who wants to connect to build out a solution and then provide the service. If that contract had payment terms, what would be he says to manage your risk, but what would be good for revenue-based financing in terms of the terms in the contract?
Yes, absolutely. So for that, the terms of the contract, like an annual contract is great. So at least let's say the commitment legally is for a year of a business relationship with this specific customer, and then the payment terms, if they're monthly or quarterly or annually. What really matters is there's like a contract behind that customer relationship. Now, important to know, and some revenue-based financing providers do this and others don't. Some are very specific contract-based, like I will finance that contract and then that contract. And CapChase many years ago started that way, but we wanted to see this as like a more holistic financing product. So essentially we pull all contracts, not just one. We pull all contracts, and that's how we calculate the entire ARR base. And then the financing that you access will be, again, between 20 to 60% of ARR. So we specifically don't look at like one specific contract, but all of them.
Excellent. Maria's got a good question here. When you're talking about 20 to 60% of future revenue, do you mean on a monthly or an annual basis? So I think you covered that in the slide, but we can answer it directly again.
Yeah, of course. So the ARR is like that annual figure. Let's say that's 10 million. You know, we look at all your contracts and all your recurring revenue, and we do that through MRR. We analyze that and convert that into ARR. Let's say that's 10 million. And after underwriting, we'll say we'll give you a 50% advance rate. That means that 50% of 10 million, so 5 million, you can access in financing today. So you can essentially draw the whole 5 million today or whatever you need, but essentially that 20 to 60% is a percentage of the total ARR base. Does that answer the question?
I believe so. Let me know if not, Maria. And similar to that, I know Sanjeev asked a bit ago, what about early payoff? Say you pull in, whatever percent, your 5 million all at once, you turn it into 10 million. Can you just pay off the remainder if you've only used $1 million of it?
Fantastic question. Very good question. Are there any prepayment penalties, right? Which I'm sure that's part of the question as well. There's nothing that's preventing you from paying early. So that you drew $1 million with a 12-month term, you realize that in month 8, oh my God, you're so cash flush that you don't need this anymore and you want to prepay early. There's nothing preventing you from doing that. There's no prepayment penalty. However, with revenue-based financing, there's not necessarily a prepayment incentive, because whether you repay on month 8 or in month 12, your cost of financing will be exactly the same. So in that example that we look live on the screen, where you drew $1 million and you need to repay $1,086,000 over 12 months, if you pay on month 8, you still need to pay $1,086,000. So there's no prepayment penalty, but there's no prepayment incentive. What, however, tends to happen where we get some companies that say, look, I'm planning to raise my A by this date, and by that date, I believe that we're going to have so much capital that I'm not going to need it for whatever reason. Those customers, what we usually tell them is like, you can do a 6-month term, right? Instead of paying, 86,000 for a 12-month term, you can pay half of that, 43,000, for a 6-month term, and that's totally an option.
Yeah, it's not like a traditional loan where there's a principal that you could pay off by paying more in advance or anything like that. It's really just like, this is the cost of the financing, these are the terms. Fabian, loads of good questions. I think we were looking at the kinds of debt on the books. Do VCs frown about looking at revenue-based financing on a company's books? Do they like deduct the balance for the money's like the company's valuation? Is it like, oh yeah, they have this much money in the bank and this much revenue, but like subtract it because it's, revenue-based financing, or their future revenues are worth less now?
So the quick answer is no. We've never had VCs that say like, oh, your company is less valuable for using revenue-based financing. In fact, venture capital funds are some of our top referring partners at CapChase. Because why do they love working with us? Because after they invest, they can essentially have their portfolio companies access capital without them having to put additional money. So they can preserve their pro rata and use it for new investments. So VC funds in that way love us. You do get like a VC fund or a VC investor here and there that will be like, oh, just wait it out until, you raise the next round or whatever reason. But it's happened very little. Usually VC funds are very friendly with revenue-based financing.
Yeah, if you're in the company already, less dilution is favorable to you. So if the company needs, oh wow, we have a chime bell now. Do you have maybe 10 extra minutes, Maria, so we can get through some of these?
I do.
But yeah, for the most part, in terms of optics, it actually shows a savvy and smart founder, because if they didn't have as much money as they wanted, or they wanted to seize an opportunity, rather than going through a 3+ month process for pitching a bridge round or VCs or on for what, they could just pull in, they're confident about their future revenues, and they get the green light. Like, that's so much easier. And all your existing shareholders don't suffer any dilution. You just, you pay for it out of your own revenues.
A lot of VCs now are really paying attention to runway. How much is your runway? Have 2 years of runway.
Oh, yeah.
You should not have below 2 weeks, 2 months of 2 years of runway. And revenue-based financing allows you to preserve that runway. So in that sense, VCs love that you're being capital efficient in that way.
Great. We'll do lightning round now, just so that we don't waste your time. Elias asked a great question. You've been talking a lot about B2B, but what about a B2C company? Could still be recurring revenue, but does that kind of single them out?
That's a really good question. So for B2C, so we personally don't do B2C. There are revenue-based financing providers that do D2C, like e-commerce D2C, like Wayflyer is a good one. OnCap does, for the most part, e-commerce D2C companies. But for SaaS B2C, like a consumer app, revenue-based financing providers, just because they are underwriting your revenue and they care about retention. Usually B2B SaaS companies have higher retention rates than B2C. So that's why they really tend to work more with B2B companies. But for B2C, I mean, D2C businesses, e-commerce, Wayflyer is a really, really good option for those businesses.
Excellent. And Seth asked a really good question, still on the topic of B2B. They're a B2B company. They've got 25 clients so far, but it sounds like the kinds of clients and the deals that they're doing, they're not on Stripe or any of these integrated, systems, that maybe they're doing big contracts, they're sending PDFs over, they're doing ACH transaction. Can you guys still handle that, or do you need the QuickBooks and Stripe integration?
Good question as well. The quick answer is yes, we can totally support that. That will just add 1 or 2 days to the underwriting process, because it's not coming directly to Stripe, ChargeBee, or Referrly, for example. So there are specific templates that we provide for those types of companies saying, please share the revenue information and the contracts with your clients with these dates and like the cohorts. And with that information, we can perform exactly the same underwriting. It's just going to take a little bit longer because you need to pull the data. And then we need to manually pull in that data as well. But again, that usually adds 1 to 2 days to the underwriting process. So it's not too bad.
Excellent. Bobby asks, hypothetically, does it make any difference if you have an LOI from a significant corporate VC arm for X millions that will take a few months to complete?
You mean does that make them more attractive to get revenue-based financing?
Yes. Or does that, if the money hasn't hit the bank, is revenue-based financing not an option?
Because remember, we don't really care about who are your investors. We care that you have revenue, that you're growing it, that you're retaining it, and then you have at least 5 months of runway. So in that case, if let's say you have below 5 months of runway, and you expect that cash from that corporate VC to hit in a month, what we'll tell you is better to do the underwriting when you have that cash on the bank and that minimum runway, because you're going to get better terms. So in that case, we'll tell you to wait. But if you already have the minimum runway, we don't need to wait for that corporate VC to come in.
Yeah, I guess the disambiguation here, and it's not clear from the question, but if the LOI from the corporate VC arm is for an investment, as in they're really considering investing you for equity, you can't that's not revenue. You can't get revenue-based financing based on that.
Oh, yes.
However, it's a contract to provide services to the corporate VC or something like that. That is revenue, but you will probably want to be realizing that revenue before you pursue revenue-based financing. You can't borrow against your future fundraising with revenue-based financing.
Exactly. There's no break. Exactly. Yeah, no. That would be, I guess, venture capital-based finaing.
I think of it as that.
That's not a bad idea, eh? That's not a bad idea. Who knows?
Yeah. Well, you string it. I think of it like what is that old paradox? Is it Zeno's paradox, where it's you can never go anywhere because you have to go halfway first, and then you have to go halfway before that, and then you have to go halfway before that, so nobody ever goes anywhere. It's I'll just stack up enough borrowing off of my future borrowing that I'm guaranteed to raise VC in 8 years. So give me a $5 loan today and it'll start the path. Could be a pyramid scheme. Who knows?
Yeah, there's a lot of very interesting creative financing products out there. So who knows?
Beltran asked, do you check our credit like a bank? You've already covered the application time and minimum requirements, but what about credit checks, both on the company itself and on the individuals?
Credit checks on that sense. So for individuals, obviously, no personal guarantees or anything like that. It's unsecured financing. For the business, no, we just basically look at your banking data, revenue data, in accounting data. And then we do obviously like a KYB to make sure that there's no fraud cases historically in your business. But in that sense, there's no such thing as like a credit check for that business that's going to impact your credit rating as it does for consumers, let's say. Yeah, we do KYB.
Yep, that's know your business. Sorry, we're throwing so many acronyms hilariously at somebody whose name is an acronym in the chat, CGR, but I've been trying to clarify them. So know your customer, know your business are similar. It's just whether it's corporate or consumer. And I think we just kicked Ravi's question, which is the last question, looking at contracts or bank statements. Yes, bank statements. Only contracts I think that deal with like revenue or the means to actually service that revenue and get it. They're not going to ask for like advisor agreements or, things that employment agreements or anything like that, right? It's mostly around the revenue-based contracts that you have. So you don't have to go through full diligence like you would with, here's my deal room with everything my company's ever done and all that kind of stuff. It's really around the business model, the financials, and the revenue.
So you can really come up with a decision a lot quicker than like with these banks do, which like they literally perform due diligence on like absolutely everything. Like we do a very like exhaustive due diligence, but it's really done through the integrations of banking, accounting, and billing.
Awesome. Well, those were fantastic questions. Thank you so much, Maria, for both taking them as we were going and up near the end. Getting a lot of praise in the chat from a lot of people, and thank you very much for those questions. This was super informative. I know we've done a similar one before, but we should repeat this at some point, at least quarterly or annually, because I think it'll really help people out, shed the light on this opportunity. I think it's going to be huge in the next coming years. Like we are not, I don't even think we've rounded the corner yet in terms of cooling off yet. So any opportunity you can to extend your runway, the name of the game in startups is surviving before you can thrive. And I think this is an awesome option. Like I said, we've actually gone through CapChase's process ourselves, so we can attest to like they're quality people, they've got good people, and it's a worthwhile perspective to get. Like I said at the beginning, we will record this. Maria, will you be able to share the slides? I could attach those with the recording and everything I send out. So we'll send all this stuff out to you within a couple of days. You can get a 10% discount if you go through the partner link. It's capchase.com/partner/Gust. I will also put that in the email that I send out. And yeah, thank you so much, Maria. Any parting words for our audience?
Thank you so much for the engagement, the questions. Like it's been great being here, and yeah, no, I'm more than happy to repeat it as many times as you guys have me here. So thank you for having me. And yeah, if you guys have any questions, my email is maria@capchase.com. I'd love to chat.
Nice and easy. Nice seeing you again, Maria. Have a great week, everybody.
Guys. Bye.